Managing student loans efficiently is essential for reducing financial stress and paying off debt faster. In Tips for Managing Student Loans Efficiently, we explore practical strategies to help you take control of your loan repayment journey. From understanding your loan terms and choosing the right repayment plan to budgeting wisely and exploring options like loan forgiveness and refinancing, this guide provides comprehensive advice to make your repayment process smoother. Today we will talk about tips for managing student loans efficiently. So before we start, make sure to hit the like button and subscribe to my channel. Understand your loans. The first step in efficiently managing student loans is understanding the types of loans you have and the terms associated with them. Student loans generally fall into two main categories: federal and private. Federal loans are issued by the government and come with various protections, such as income-driven repayment plans and loan forgiveness options. These include direct subsidized loans, direct unsubsidized loans, direct PLUS loans, and direct consolidation loans. On the other hand, private loans are issued by banks, credit unions, or other private lenders, and typically lack the flexible repayment options offered by federal loans. It's crucial to review the details of each loan you owe, such as the interest rate, balance, loan servicer, and repayment terms. Make a list or use a loan management tool to keep this information organized. By understanding your loan terms, you can prioritize which loans to pay off first, especially if some have higher interest rates than others. Create a comprehensive budget. Managing student loans starts with creating a detailed budget that outlines your income and expenses. Knowing exactly how much money you have coming in and where it's going allows you to allocate funds toward your loan payments systematically. Begin by listing your sources of income, including your job, side gigs, or any other revenue streams. Next, categorize your expenses into fixed costs, like rent, utilities, and loan payments, and variable costs, such as groceries, dining out, and entertainment. Once you have a clear view of your finances, identify areas where you can cut back. Reducing discretionary spending and redirecting those funds toward your loans can significantly accelerate your repayment. Use the 50/30/20 budgeting rule as a guideline. 50% of your income goes toward necessities, 30% toward wants, and 20% toward savings and debt repayment. However, if you're dealing with significant student debt, consider adjusting this rule to allocate more toward loans. Choose the right repayment plan. Federal student loans offer several repayment plans, allowing you to select one that best fits your financial situation. The standard repayment plan, which involves fixed payments over 10 years, is the default option and generally results in the least amount of interest paid over time. However, if your income is insufficient to cover these payments comfortably, you may want to consider income-driven repayment (IDR) plans. IDR plans, such as income-based repayment (IBR), pay as you earn (PAYE), or revised pay as you earn (REPAYE), cap your monthly payment at a percentage of your discretionary income and extend the repayment term to 20 or 25 years. After this period, any remaining balance may be forgiven, though you may have to pay taxes on the forgiven amount. Keep in mind that extending your repayment term will increase the total interest paid over time. If you have private loans, repayment options are generally less flexible. However, some lenders offer forbearance or deferment in cases of financial hardship. Always communicate with your loan servicer to explore the options available to you. Prioritize high-interest loans. If you have multiple student loans, one effective strategy is to focus on paying off high-interest loans first, a method known as the avalanche approach. By prioritizing loans with the highest interest rates, you minimize the total amount of interest paid over the life of your loans. Continue making minimum payments on all other loans while directing extra payments toward the loan with the highest rate. An alternative method is the snowball approach, which involves paying off the smallest loans first to gain psychological momentum. While this strategy may not save as much on interest, the sense of accomplishment from clearing debts can motivate you to stay on track. Choose the method that best aligns with your financial goals and personal motivation. Make extra payments whenever possible. One of the most effective ways to pay off student loans faster is to make extra payments whenever you can. Even small additional amounts can make a big difference over time by reducing the principal balance and the total interest accrued. Ensure that any extra payments you make are applied directly to the principal rather than future interest. Most loan servicers allow you to specify how you want extra payments applied, so take advantage of this option. Explore loan forgiveness and assistance programs. If you work in certain professions or under specific conditions, you may qualify for loan forgiveness or repayment assistance. The most well-known program is Public Service Loan Forgiveness, PSLF, which forgives the remaining balance on direct loans after you make 120 qualifying monthly payments while working full-time for a qualifying employer, such as a government or nonprofit organization. Teachers, nurses, and members of the military may also have access to specialized loan forgiveness or repayment assistance programs. Automate your payments. Many loan servicers offer interest rate discounts if you set up automatic payments, usually around 0.25%. Automating your payments not only saves you money but also ensures you never miss a due date, which is crucial for maintaining a good credit score. Late or missed payments can result in late fees, increased interest rates, and a negative impact on your credit. However, make sure you have enough funds in your account each month to avoid overdraft fees. Take advantage of tax deductions. The IRS allows you to deduct up to $2,500 in student loan interest paid each year, which can lower your taxable income. To qualify for the student loan interest deduction, your modified adjusted gross income, MAGI, must be below the annual threshold set by the IRS, and you must be legally obligated to pay the interest on the loan. Consult a tax professional to see if you qualify for this deduction and to ensure you're maximizing your tax benefits. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.